We've been in a liquidity consolidation for quite a while, and those can only last so long because the system is designed such that it always needs more liquidity. And so that plays into a lot of my view of why the next 2 years are probably going to have another up leg in liquidity. And we are off the highs in liquidity, which occurred back in late 2022. So it's not that I think liquidity is going to be terrible. It's just I don't know if we're going to have like a big vertical move in liquidity, which if that were to happen, I think we get that big vertical move in Bitcoin most likely.
Approximately 2 weeks ago, Treasury Secretary Janet Yellen confidently declared that the U.S. had successfully achieved a soft landing after years of economic concern stemming from the unchecked money printing and multi-decade high inflation rates following the pandemic. Yellen expressed her optimism during a CNN interview, stating, "What we're seeing now, I think we can describe as a soft landing, and my hope is that it will continue." Her remarks came shortly after the release of the December jobs report by the U.S. Bureau of Labor Statistics, which revealed the addition of 261,000 jobs, surpassing expectations. However, the optimism conveyed by the jobs report contrasts sharply with the inflation report released the following week. According to the report, the consumer price index rose by 0.3% in December and 3.4% from a year ago, slightly exceeding economists' estimates. Core CPI also increased by 0.3% month-over-month and 3.9% compared to the previous year. Despite these figures not necessarily signaling significant economic challenges for the United States, they cast doubt on Yellen's optimism. In fact, economists from major financial institutions like J.P. Morgan still view a recession as more likely than not in the coming months, with forecasts of economic declines for China, Japan, and other major economies in 2024. In a recent interview, renowned macro analyst and investment strategist Lyn Alden shared her outlook for global liquidity in 2024 and beyond. Alden noted that while it's premature to accurately predict macro conditions for 2024, the typical outcome of each economic cycle is an increase in liquidity, with central banks poised to inject a record amount into the system. While this may lead to further currency devaluation, Alden sees it as favorable for Bitcoin prices. She believes that the leading cryptocurrency is positioned for significant price surges within the next 2 years due to this influx of liquidity.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The Fed is only one input of many into global liquidity. In the US, the big inputs are the Fed and the Treasury together. And then globally, you have to consider other major powers like does China stimulate or not stimulate as well, because they're a huge entity. And so the Fed is one input there. And to some extent, I think that it's not fully in the Fed's control. I mean, basically, when there are liquidity events in really key markets like treasuries, they kind of lose out to the fiscal side. And so it's less about what the Fed decides to do. It's about the timing of things that will force them to do certain things. One of the reasons I've been a little bit more cautious on my statements throughout 2024 is because I'm not sure if liquidity is going to be really good or not this year. And I do think that Bitcoin is likely to be relatively correlated with liquidity. It doesn't mean that, on a week by week basis it does what liquidity does, but it's so far, at least in the kind of first third of Bitcoin's life, it wasn't really correlated to anything because like if one doctor decided to buy Bitcoin that day, that moved the price. It was small enough, or if someone else sold, that would move the price. But ever since Bitcoin became big and liquid enough, kind of in the second half of its life, and really kind of the second 2/3 of its life, it's had that correlation with liquidity. And one way to think about that is that when you're comparing the Bitcoin and dollar exchange rate, you have to take into account what both of those monies are doing. So Bitcoin is the growing, harder, emergent money. The dollar is the big incumbent money, and the dollar goes through periods of hardening and loosening. On net, it's kind of structurally loosening. That's what it does, but it goes through these kind of periods of hardening. And so when it's doing that, it's pretty rare that Bitcoin is going to do well in that environment because it's getting pushed around by this bigger money that is the unit of account for much of the world. And so I kind of have a very mixed outlook for liquidity this year, or at least the first half of the year. And so when people ask me what I think Bitcoin's going to do, I keep giving kind of a 2-year view because I think I have better visibility on what happens in the 2-year view. I think that liquidity is probably higher 2 years from now than it is now. But over the next 6 months or 9 months or 12 months, I don't really have a firm view on that. And so that's why I'm maybe a little bit more cautious around my statements than a lot of other Bitcoin bulls are, because nothing between $30,000 and $120,000 would surprise me. Because one is Bitcoin's that volatile, and two, liquidity is that uncertain in this calendar year, at least in my opinion. And I try to track liquidity pretty closely. So you have to take into account, what is the dollar index going to do compared to other major currencies? What is China going to do? What is the Fed going to do? What is the Treasury going to do? What are banks going to do? Right. So there's multiple variables that feed into that. So it's not that I think liquidity is going to be terrible. It's just I don't know if we're going to have like a big vertical move in liquidity, which if that were to happen, I think we'd get that big vertical move in Bitcoin most likely. But I don't know if that happens this year, next year, maybe between the 2 years at some point. And so that's kind of how. And if you look at the halvings, I mean, the halvings are relevant for Bitcoin, but sometimes the bull run is happens right around that time. Other times it's delayed for a period of time. And that's in large part because the actual timing tends to be more correlated with that liquidity component. The halving plays a really big role in terms of, I think, why it has higher highs and higher lows. I think it plays a really big role in the bear markets, like 2 years later, when not that many people want Bitcoin anymore, and there's still Bitcoin coming to market, but it's less because of the halving. That helps set the higher floor. The kind of the hodlers of last resort have less supply to absorb. But in terms of timing around the halving itself, I think liquidity is generally a bigger catalyst.
All indications suggest that liquidity will be a significant concern in 2024. Ironically, the issue won't stem from a depletion of liquidity, but rather from increasing liquidity conditions, according to recent reports. The International Monetary Fund is monitoring potential market liquidity risks as countries prepare to refinance the debt accumulated during the pandemic. Last week, the IMF's first deputy managing director, G. Gopo, highlighted to Bloomberg News the looming threat of a massive wave of liquidity being unleashed on the global economy due to the extremely high levels of debt. Debt is at extremely high levels, she remarked. What worries me on top of that is that we have projected fiscal deficits that are going to be higher than they were pre-pandemic. Many countries borrowed a lot during the pandemic that was short-term in nature, and that's coming due. So, I think liquidity risks are something we should pay attention to. This perspective from the IMF deputy director aligns well with Alden's recent predictions of a liquidity surge in 2024 to 2025. We invite you to share your thoughts as we delve into more excerpts from Alden's interview, this time focusing on the monetary and fiscal policies in the U.S. and the efficacy of the Fed's rate hikes.
So there's monetary policy and fiscal policy, and when the two go in opposite directions, usually fiscal policy wins, but it's not always a smooth ride. It can be very bumpy. And so monetary policy refers to basically what the Fed's doing, or in another country, what that central bank is doing. And that basically is, what are short-term interest rates set at, because it's essentially controlled interest rates, and then also balance sheet. What is the changing of base money doing? Because that affects liquidity. So those are the two variables primarily that the central bank has to play with, whereas the fiscal side is more about how much is being taxed and where it's being taxed from, and how much is being spent and where it's being spent, and then specifically the delta between those two. So how large is the deficit and who primarily is receiving a lot of that deficit. And they can go together. Like, for example, during the pandemic lockdown stimulus response, you had both. You had the fiscal authority spending a lot of money, but as they're issuing trillions of dollars of bonds, the Federal Reserve is creating new base money and buying a lot of those bonds. And so you're printing money, but then you're also getting it out into the people's pockets. And so, but ever since we started to get inflation, the Fed's been tightening up. So they're saying, okay, we're raising interest rates and we are reducing our balance sheet. But the fiscal side is still, they're not doing like stimulus checks anymore, but they're still running a structural, largely demographics-driven deficit. And what makes it complicated is that as the Fed raises rates, it loosens the fiscal side even more because it raises their interest expense. And someone out there is receiving that money. It could be the foreign sector, it could be banks, it could be insurance companies, it could be upper middle class or wealthy people that have a lot of cash.
Us in money markets. Yeah, exactly.
So people are receiving that money, and that has some propensity to be spent. It's not as rapidly spent as stimulus checks tend to be, but it is income to various entities that can go out and spend it. And so the way that I keep describing that is, so back in the 70s, like money creation comes from two sources, either that monetized fiscal deficits or bank lending. And the central bank, the monetary policy is mostly designed around controlling bank lending. So things that encourage them to lend more or things that encourage them to lend less, or the other way around, people to borrow more or borrow less. And so in the 70s, most of the inflationary money creation we had, the majority of it was from bank lending. And that was in large part because the baby boomers were entering home buying years. So there's a lot of demand for credit and there was a lot of provision of credit. And so you had a lot of broad money supply growth at a time when we also had, we were running fiscal deficits. We also had oil shortages, things like that. But the biggest component was that money creation, the lending. And so we had very low public debt to GDP. And so when the central bank raised rates very high, kind of the classic Volcker, the well-known historic Volcker moment, that put a big brake on bank lending. And although it did increase the fiscal deficit because it increased the interest expense of the government, it was less, the downward push on banks was bigger than the upward push on the government because the government debt was so low. So if you raise interest expense on 30% debt to GDP, that's only so impactful. Whereas if most of the money creation is coming from bank lending and you kind of slow that down, that the monetary side is winning there. On the other hand, if you fast forward 40 years and now debt is 130% debt to GDP, when the central bank raises rates, on one hand, they do slow down the bank lending. We've seen that in the data. Bank lending is kind of at stall speed right now. It's very slow. But now there's just more and more interest expense pouring out into the economy from the government. And so that magnitude is roughly equal, right? So kind of the slowdown in bank lending is roughly equal to the increase in interest expense. And if you fast forward even further, to get to like a Japan situation, if they raise rates, it'd probably be outright pro-inflationary because the fiscal side would be actually so much bigger than the loan side, whereas we're more in that middle range right now, which is partially why their tools are not as effective. And that kind of is the hallmark of an end of a major cycle, like a long-term debt cycle.
As per Alden's analysis, we find ourselves at the culmination of a 50-year cycle, tracing back to the turbulent economic conditions of the early 1970s, marked by the adjustment struggles following the introduction of the fiat money system. This was succeeded by a period of relative stability in the late 1970s and early 1980s, leading into a prolonged bull run in the stock market, which eventually met its end with the bursting of the dot-com bubble. The aftermath prompted central banks to intervene, stimulating the economy and inadvertently inflating a substantial housing bubble, culminating in the widespread banking collapse of the Great Financial Crisis. Alden further notes that the subsequent interventions by central banks, characterized by multiple rounds of quantitative easing, have pushed the bubble to the sovereign level, leaving little room for further expansion. Consequently, Alden warns that we may be on the brink of a more potent burst, this time at the sovereign level, with the potential to precipitate a systemic collapse. What are your thoughts on Alden's prognostications and their implications for Bitcoin and the global economy? We welcome your comments and insights in the section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.